You have to remember that when people buy stocks, they're not buying stocks based off of what they think is going to happen today. They buy stocks based off of what they think is going to happen in the future. So the stock market kind of prices in the future economic expectations. What you don't want to get confused is confusing the stock market with the economy, because the stock market is not the economy. The economy is what's going on in the world right now. The economy is whether you have a paycheck, whether your neighbor has a paycheck. What is going on in the economy is the economy. The stock market is what people think is going to happen in the economy in the future. The way Warren Buffett explains it is, in the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine. Essentially, in the short term, the stock market can be very emotional because people can start panicking and they'll start selling, and then they can get really excited and they'll start buying, and this can push the stock market up or down. We've talked about this on our YouTube channel, which is why if you haven't subscribed yet, make sure you do that. But over the long run, the stock market tends to rationalize. If we focus just about pricing, like I talked about earlier, you have to look at supply and demand, and you have to look at how much money is in the market. Money in market. Because if there's no money going into the market, stock prices are going to go down. But if you have a ton of money going in the market, at least in the short term, you're going to see stock prices go up. And so you have to look at the factors that affect the money in the market. Every financial analyst and money manager will tell you that the thing that affects the money in the market is how well the economy and companies are doing, because if companies are doing really well, it's going to attract more people to invest in the market. But I'm going to talk about this when I talk about valuations. In this section, I really want to just talk about what affects the money in the market. If people have more disposable cash, what we've seen happen now is people are more likely to invest in the stock market because of the growth of digital brokerages. So a couple things that affect this are digital brokerages and cash that people have. So if and when people get more stimulus checks, there's a good chance that some of this money is going to go into the market. Second thing to look at is regulations, because when the 401k was created, guess what? That pushed a ton of money into the market, because now it created a system where employers and employees can invest their money into the market, and your money gets tied into the market, because when you invest in a 401k, you're not taking that money out until it's time for you to retire. So if we see more regulations that incentivize people to invest in a 401k or to create more investments like that, then that could put more money in the market. The next thing you have to look at are interest rates, because this recession isn't over, and there's a very good chance we could see interest rates drop even more. Now, as interest rates come down, it makes borrowing money cheaper, and now institutions can borrow more money, and where will they throw it? Back into the market. So if interest rates come down, money supply goes up, and if the money supply goes up, chances are we're going to see more money go in the market. And the most interesting one of these things are probably buybacks, because the way buybacks work, if you remember in 2020, there was a lot of negative kind of publicity around stock buybacks, is where a company has a ton of cash in their bank account, and now what they do with this cash is they use this cash to buy their own stock. So a company is deploying cash into the market to buy their own stock, and this essentially acts like a big buyer of a company, and this pushes stock prices higher. Well, in 2020, after this whole pandemic started, there was a really kind of bad PR around buybacks, because naturally a lot of companies wasted a lot of money on buybacks and then didn't have any money to take care of themselves when this pandemic happened, and so taxpayers had to come in and bail out these companies, and so you saw almost no buybacks happen in 2020. Well, after that, lots of companies got very precautious, and they started saving a lot of cash because nobody knows what's going to happen in this pandemic, and everybody was worried, and so companies started saving a lot of cash. And they also weren't doing any buybacks in 2020 because of all the negative press around buybacks. But if we go into 2021 and this pandemic goes away and this kind of risk factor goes away, then what we might see is that these companies have a ton of cash that they're not using, and this cash could now be used as buybacks, because we didn't see that many buybacks happen in 2020. So 2021 could be the year of buybacks if corporations have a lot of cash that they're now ready to deploy into the stock prices, which would make stock prices go up even more. Second, let's take a look at valuations, because you might have heard people talk about how this stock market that we're seeing is the most overvalued stock market in history. All valuations really mean is how much this company is selling for. So if you're a company and you made $100,000 in profit, the question is, if you were to sell your company today, how much would somebody be willing to pay for that company? If you made $100,000, maybe somebody's willing to pay $1 million, or maybe they're willing to pay $10 million. The question is, what is a fair valuation? Now, there's not one single right or wrong answer here, because some industries are going to have much higher valuations than others. Like if you are a restaurant, then maybe it's 15 to 18 times earnings. That's kind of a general range. If you are a tech company, then it's going to be many times more than that. I mean, we're seeing some tech companies that are selling for 100 times earnings. So if you make $1 in profit, you're going to sell for $100. If you make $1 million in profit, you're going to sell for $100 million. This valuation debate gets really heated because lots of people say it doesn't make sense for a company to be valued at 100 times earnings, especially now because some tech companies are being valued at 1,000 times earnings. So if you make $1 million, you're not selling for $100 million, you're selling for $1 billion. And so some people say these valuations just don't make any sense. Well, this is where you have to kind of come in and be a judge and decide what's a fair valuation. The reason people are saying that this is the most expensive stock market in history is because valuations are higher than we have ever seen before. Now, the one caveat that you really need to understand about that is that right now, the reason why valuations are higher than kind of what we saw in February is because right now, a lot of companies are not making the money that they were back in January or February or back in 2019 because of economic shutdowns and because of slowdowns, because of this pandemic. So based off of today's profits, yeah, the valuations are really high because a lot of companies are not making any money. What people are doing is they're valuing companies today based off of how much money they think the company's going to make in the future, because a lot of people, especially investors, have their eye on the future where the economy will open back up and this pandemic will be gone. And so they're valuing companies based off of what it will be post-pandemic. So if 2021 and 2022 come and the economy opens back up and companies are making a ton of money, then these valuations might come down because now companies are making profits, assuming stock prices don't go up significantly, and then valuations might go back to normal levels. But if the pandemic slows down and the economy doesn't recover, and now companies have these super high valuations, but companies aren't making any money, now that's going to create some issues because you have super high valuations for companies that are not making any money, and the future is going to look more bleak then, and that's where you could see a correction. And that's why you have to look at number 3, what could cause a stock market crash? What are the potential triggers for this? Now, just so we're all on the same page, typically when we talk about a stock market crash, we're talking about a 20% drop off of a stock's highs. Anything less than 20% and it's considered more of a correction, and more of 20% and that's considered more of a crash. There's 2 ways that I want to analyze this. One from an emotional level, because as we all know, the stock market is emotional, and second, from a more fundamental level. So looking at the economy, looking at jobs, looking at the value of our dollar. What we saw happen back in March of 2020 was an emotional crash because everybody was scared, everybody started panicking, and people started panic selling. Now, if lockdowns come back and we see this pandemic get worse, we could see more emotional selling, but chances are we're not going to see a March type of stock market crash emotionally because, well, we've already experienced it. That kind of like initial shock factor is gone because we've been living through this pandemic and we kind of know what's going on. So yeah, I mean, if things get worse than expected, then we're going to see an emotional sell-off. But we're talking about like an emotional crash we saw back in March. I don't think it's going to happen. Now, I could be wrong, but I just don't think we're going to see it happen because people are more familiar with what's going on in the market and that initial shock factor isn't there. The second thing we want to look at is what AK calls a sentimental indicator, because back in March, and what we see happen time and time again, is anytime all the news headlines are bearish, meaning pointing downwards, then typically that means it's a good time to buy. And if you see all the headlines saying the stock market cannot go down, then that's typically a good time to sell because that might mean the stock market will be coming down because everybody thinks the stock market is going to go up. So it's kind of like a contrarian view to the media, because what we've seen happen is when the media says that the world is ending, that's a good time to buy stocks. And when the media says the stock market cannot be stopped, that's usually a good time to sell stocks at the top. When all the headlines said that the economy is over and the stock market's done for, that's when we had all the cash on the sidelines and the stock prices were down. So that was a good bullish sign, meaning the stock market would go up because now there's a lot of cash on the sidelines and there's a lot of potential in the stock market. Now what we're looking for is if all the media says that the stock market is going up, meaning bullish stuff, then that means that all the extra cash is deployed in the market and now there's no excess cash waiting to be put in the market, because if there's no more cash going in the market, then that kind of limits the upside in the stock market. At the time when we're recording this video, we're not there yet. We're seeing kind of a blend of good and bad bad headlines, which means there's probably more cash sitting on the sidelines that still has not been deployed. What you want to pay attention to is once everybody starts talking about how the stock market cannot be stopped and the stock market's going to go up forever, that's when typically what that means is there's a lot of cash that's now in the market and there's not a lot of extra cash outside of the market, and you may want to kind of use that as a signal that the stock market might be hitting highs and could be getting ready for a correction. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.